Everyone. This week before the holidays begin, I hope everybody's getting ready for the holidays and in a good mood. See a lot of our friends here and some new people. My name, by the way, is Tom Malingo. I'm here with Susan Bryanton, my wife and co-founder of Brandjectory. Today, we will be joined by Jen Palmer in just a little bit, who's going to talk about funding options and what lenders are going to be looking for and what brands need to do to be ready for financing, especially as 2025 comes up. For those of you who don't know Brandjectory, if you haven't been on one of our webinars or attended one of our events, we are an educational and engagement platform for brands under 10 million in sales, CPG brands, all the brands that are at Whole Foods and Sprouts. That's who we serve. We do that through an educational knowledge base of some 350, 400 articles and videos that describe every aspect of building a brand, a little one-on-one consulting from our team. But then the main thing, what we do is a monthly series of engagement meetings with investors, industry experts like Jen and others. Some of it is group sessions for speaking with a classroom session with a capital raise expert to answer questions or a legal expert to answer any questions. Others are more one-on-one, like practice pitch sessions with an investor, which we record and get back to you. A service we call the Space Toolbox, which is to go one-on-one with an industry expert or an investor on a problem of your actual needs. We have a number of mentors that we can introduce people to, and we're excited to do that. We have founder-only problem-solving sessions and founder-investor meetup every month, where we get together with investors. They deliver a small discussion on a topic of importance, and then we break into small rooms where there'll be an investor and several brands, chance to talk, communicate, introduce each other, get to know each other, and start building relationships. We can do some special services of reaching out for brands that are in the middle of fundraising. But a lot of what we do is simply about making sure we pass along education, contacts from our 750 investor network and some 150 mentors, and just really give the chance for brands to learn how to build a strong CPG business and really accelerate their meeting and getting to know and understand who are the players, who are the experts in CPG, and how they can help them over the time of their growth. So we like to think of ourselves as the lifelong accelerator for brands throughout the course of your growing your brand and the life cycle of your brand. With that, I am going to turn it over to Jen Palmer of J. Palmer Collective. I already told you what Jen's going to talk about. This session will be recorded, but we're excited that Jen is joining us today. With that, I'm going to let Jen introduce herself, her background, and start the process. If you do have questions, please put them in the chat. We will have a Q&A at the end of this, and I will be, Susan too, will be monitoring the Q&As. And if there's something that we want to break in and let Jen know that she could continue to talk about, we will do that. But in the meantime, please make sure you put your information, or excuse me, any questions you have in the Q&A. I will be sharing Jen's contact information and some other things in the chat as we go along. But with that, I'm going to turn it over to Jen. And Jen, thank you for being here. Happy holidays to you. And please, let's start the program.
Well, Tom, thank you so much for having me. Susan, thank you for having me. And happy holidays, everyone. I am sure you all have a very long list of things that you want to be doing the week before Christmas and the holiday break. So I really do appreciate you being here, and happy that this is being recorded for all those who wanted to come but just couldn't because they had to take a 2 o'clock phone call the Monday before Christmas. So, but very honored to be here. My name is Jen Palmer. I have been in finance for nearly 20 years, and I have financed companies from 0 in revenue to 100 million in revenue. Companies like Zoa, which is the Rock's energy drink company. Companies like Stasher, which replaced a single-use Ziploc bag. Numi Tea, which is a leader in fair trade. Kula, which is a leader in natural sunscreen. And for every company that I've financed, I've turned down 98. So I have looked at thousands and thousands of companies over the years, and I have almost seen it all. And many times I think I absolutely have seen it all, but I am constantly surprised by what is out there. But I probably could write a book. So today, what I wanted to do is just share with you a few things that you as a business leader can do and also avoid in order to secure a line of credit to help grow your business. To start off, I thought it would be a good idea, though, just to run through some of the different finance options that are out there and share with you some insights on what leaders are looking for and lenders in particular are looking to see, and where they can work with borrowers and how borrowers can help maximize their statistics or their success for obtaining a financing option. And there's different financing out there, and it's a lot, very, very overwhelming. So if you're a business entrepreneur and you're saying, how do I bring capital into my business, I don't know, it's so overwhelming, well, then you're just being honest, and all of your competition feel the same way, because if you're not from financing, you wouldn't be familiar with all the options out there. So let's start first with what are the options out there for you. So what I'm trying to do right now will be the most difficult part of today, and that will be to share my screen. And I think I've already mucked it up, but let me try again one more time. Oh, I keep pressing the wrong button. So Tom, have patience with me as I try to do it. Okay. All right. So I think I've got it here. So this should be, hopefully you can all see my screen. Tom, you're able to
Yes, we
see it?
can. We can see your
All
screen.
right,
You're ready to go.
wonderful. All right, there we are. So now we're just gonna try to figure out how to go from one slide to the next. So that's me. So today we're going to talk about preparing for finance, what leaders and lenders need to know. Borrowing or raising equity, it is a two-way street. And that's the most important thing that you need to know, is that it is a relationship. And relationships come in all different styles. And so I always say debt is like dating and equity is like marriage, but it's a two-way street. So make sure that you get to know your investor, your capital provider. Do your diligence on them, they'll do it on you. But debt, it's temporary. It's easy to unwind if you don't like it. But equity, like marriage, it is meant to be forever, or at least for a very long period of time. If you want to get out of your relationship, well, debt is very easy, just like dating. You just break up. Maybe there's some fees to break up. There's some breakup fees. And, it's a little bit of paperwork, but it's pretty easy to break up. Equity, on the other hand, like marriage, well, if you're looking to get divorced, it's going to be difficult. It is complicated, it is expensive, and most importantly, it is very emotional. So when you're trying to figure out what is the kind of financing or capital that you're looking to bring into your company, make sure you really think about it from reality. Think about it debt like dating, equity like marriage. Another way to think about it when you're thinking about how to finance your business is think about it just like when you're buying a piece of real estate, debt and equity. So most people I know that buy real estate, well, they want to buy a piece of real estate and they understand that they need to bring in equity and leverage. Equity is the amount of money that you can put down. And if you're going to a bank, you usually need about 10 to 20% of a down payment. And then the bank will give you the mortgage for the rest of it. So the 10 to 20%, that's called your equity, and the mortgage is called your leverage. That's great. That usually works well for many people. It's becoming more difficult with inflation. And depending on where you live, I live in New York. So, that 20% is pretty meaningful. But if you yourself have the equity, that's great. Sometimes you need to borrow from parents, friends, and family, but you need that equity in order to get a mortgage. That's how most people get started. And most people can't get that piece of real estate that they want without getting a mortgage. If they were just going to use equity, oftentimes they just have something smaller without the leverage. However, you can't get the leverage without the equity. So it's really like a chicken and an egg type situation many times. I like to think about it as a good balance. So when you buy a piece of real estate, you want a certain amount of equity and you want a certain amount of leverage. And then you buy a piece of real estate that you can afford to service the debt on a monthly basis. And just like in business, you want that same kind of balance as well. In order to get a business of a certain size, oftentimes that you will want leverage. And so that means debt. So when you bring in equity though into your business, it's like bringing in it's an owner into your house. So using the real estate example, that capital provider is now the owner with you. So using the real estate example, they're now entitled to pick out the curtains with you. entitled to pick out the paint color with you. It can be very intrusive. But yet, many companies think, let me just go and raise money. Let me just bring in venture capital because they hear about it. Joe walks into a restaurant. Oh, we just raised $30 million of equity. Everyone's very impressed. Nobody's thinking at what valuation. So, if you are going to bring in equity, if you are going to bring in a shareholder, you really want to make sure that you understand there's a difference between bringing in an economic partner as well as a control partner. You can give up 100% of your company and still retain 100% of control, but you need to understand how you do that and you need to understand your options. Most companies think that venture is the best way to go about raising capital for their business. And venture is probably the most common option for young companies, particularly in CPG. And that is where investors provide capital in exchange for equity, in exchange for ownership. This is often necessary for young companies and it serves a purpose, but it is hands down the most expensive form of financing. Oftentimes, investors miss because they compare debt to equity. So the idea is that an investor will come in and they will value your company based on the valuation that it is on day one. But you, as the entrepreneur, you should be thinking about when you sell this company, what is the valuation going to be like farther down the road? And now you don't want to have unrealistic expectations, but you need to have a meeting of the mind. And so let's just use an example. If you bring sorry about that. I thought I turned my notifications off, but if you bring in $1 million using debt and say it costs you 10%. Well, now you have financing for, call it $100,000 on an annual basis. If you keep this financing in your business for 3 years, it's going to cost you $300,000. But if you bring in $1 million using venture, at a minimum, you have to give up 10%. Now, fast forward, think a few years down the way. Now you're going to sell your company for $5 million. Well, you just paid $500,000 for that $1 million. So you actually paid $200,000 more. You didn't realize it because you didn't see the coupon on day one, but it is absolutely more expensive. So financing through debt is usually cheaper and it's usually allows you to provide, more flexibility in your business. You can have more autonomy, but it plays a purpose. Going back to the real estate example, you do need to have equity on your balance sheet in order to get to that place where you want to be, where you can get debt. So there's a couple of different ways that you can bring equity in. Convertible debt is the first way, and it's debt, right? So it doesn't seem like equity, but lenders who come in later will treat it as equity. Convertible debt is friendlier than just giving up equity on day one because you're not giving it up right away. In a convertible debt situation, the company pays interest on the borrow amount. It's typically at a lower rate compared to traditional debt, and it offers flexibility because you don't have that conversion right away. There's a maturity date at which the principal must be repaid if certain conditions haven't been met. So, what's nice about convertible debt is you've brought in some money. It's still treated as debt on day one, but you are still the owner of your business. Yes, the people that provided you with this debt will become an owner probably at a later point in time, but on day one and for the foreseeable future, you are still the owner and you can prove to your note holders that you know what you're doing and you're in control. So it's great. Safe note is a different kind of option. It's very similar, but there are some nuances to it. It's called a simple agreement, basically, and it's for future equity. So the same idea that you're bringing in debt, it will convert to equity, but at a later point in time. There are some nuances, like I said, compared to convertible debt. It does not accrue interest and it does not have a maturity date, but instead it promises to change into equity at a later point in time upon different occurrences. Safe notes have been very popular in my experience over the last few years. I talked to a brilliant entrepreneur this morning, and she was saying that in her world, it wasn't as common. And so she tried to raise money using the safe note option, but she spent more time trying to understand and help investors understand what she was talking about rather than talking about her business. She was teaching them about a safe note. So, convertible debt, safe notes, the difference is they're really just legal instruments that help you bring in convertible debt. So it's debt that will change into equity at a later point in time. In the end of the day, it really doesn't matter what kind of legal instrument you use. It's just not giving up equity on day one. And that's what's so important about it. Either of these options, a convertible note, a safe note, or even venture, they will allow you to scale your business and bring in debt. And I know we've all been raised probably thinking debt is negative. It is a four-letter word. We're taught debt is bad. There's this negative stigma around debt, but even big companies have debt on their balance sheets, and most businesses need it in order to get the company that they want. So even really healthy companies have debt, and usually they have it through bank debt. And when I talk to companies and they come to me and they say, why should we bank with you instead of Bank of America? The first thing I say to them is, if you can get institutional financing through a bank, you should absolutely do it. If your bank is doing $10 million of revenue, a consistent 500,000 or $1 million of bottom line, if you have a healthy, consistent business that is not high growth and not highly seasonal, there is no better way to scale your business than use the equity that you have and leverage it with bank debt. It is the easiest, most affordable way to do it. But most businesses, and in my experience in the CPG world, are not as consistent, especially when they're growing. They need more flexible options. I find that if a company is going up, if it's a high growth company and it's just, going from 10 million in revenue to 20 to 30, it has the same issues as a company that's about to file for bankruptcy. And that issue is cash flow. And if you're having cash flow issues, bank debt is probably not the right option for you. In that case, you need a more flexible option. And there's all kinds of private options out there. What I do is asset-based lending. That's just one of the many kinds of private options out there. Asset-based lending is a great product because it bridges the gap between the buy and the sell in a business. It helps accelerate your cash flow as well as your sales cycle. But with asset-based lending, you have to have the assets in order to leverage, in order to get that line of credit. So what we do is we look at a company's balance sheet. We look at their accounts receivable. We look at their inventory, if they have M&E, commercial real estate. We even look at the trademarks. And with that, we come up with a formula that allows a company to draw down, borrow money from us, and immediately accelerate their sales cycle. We give them money against their assets, which help their assets grow. And as the assets grow, we give them more money. So it's a really nice product for companies that are growing. But again, it's a securitized lending formula. So if you don't have all those assets on there, it's not the right product for you. But there's many others out there. Factoring. Factoring allows companies, again, to bridge the buy and sell in their business. So with factoring, you can actually pledge your receivables to a factor. It looks very different than asset-based lending, but it's very different because there's no inventory advances. And also in a factoring situation, the lender is not actually lending on your AR, but the factor is actually buying your accounts receivable. So using an example of, say you have an order to Target, it's $100,000 that Target owes you. I would lend you $85,000 against that $100,000. You're responsible for collecting that money on your own. A factor will actually buy that receivable from you. The factor will buy that order of $100,000 and they will collect on that. They'll maybe give you $90,000, but then when the $100,000 comes in, that's theirs and they keep it. And if it doesn't come in, they're responsible for collecting that money for you. So it's a really great option if you don't have a large back office, if you don't want to be responsible for collecting your AR. And also oftentimes you can get credit insurance associated with it as well. So if you're an inventory company and you need inventory financing, factoring is probably not the right idea for you on its own. But if you have large AR, good receivables, good debtors, it's a great option for you. But you may also need purchase order funding because you're not getting anything on your inventory. And purchase order funding is exactly what it sounds like. A lender finances purchase orders so the company can fulfill them. Again, using that $100,000 order from Target, if you actually have a purchase order from them and you can't afford to go and get that inventory created, you can take that purchase order from Target and you can go to a purchase order funder and they will actually advance you on that purchase order. So you can go and fulfill that order with the supplier, pay the supplier directly, and then get that order filled. And then oftentimes you can even have a factor take that purchase order out. So together, PO funding and factoring can do what an ABL lender does in one shop. And the next two examples are very specific: equipment financing and also commercial real estate. It's exactly what it sounds like. If you have equipment, if you have commercial real estate, you can probably get that financed, and that's a nice way to bring liquidity into your business. Inventory financing, well, this is unique because this is how I got my start in the industry. When I joined the industry back in 2006, I joined a company called Gerber Finance. I was one of two lenders in the United States that was financing inventory, very different than financing POs, because with inventory financing, you're financing the movement of inventory, not the purchase orders. It doesn't have to be drop shipped. The client can actually hold the inventory. This kind of financing is very, very helpful for companies that are high growth who need to build their inventory. Maybe they're very seasonal. So, for example, I've used this with Halloween costumes, flowers, sunscreen. It is very helpful. It's a very unique product, and it's become more common for companies that are D2C. So, companies that are e commerce, they don't have any accounts receivable, they may find inventory financing is a great product for them. Similarly, for D2C companies, e-commerce companies, we've all heard about MCAs, revenue-based financing. This is where you bring in capital based on your projected future sales. The repayment schedule is based on those sales. That's usually a percentage of your sales. Oftentimes this gets a bad rep, but like a credit card, this is where, people think debt is negative, but you know what? It serves a purpose. And so I don't say anything negative about any products because it all depends on what your business is doing, what your sales cycle is like, what your supply chain is like, what your distribution is like. You really need to figure out what is the right form of financing for you. And it can be very overwhelming. We talked about this in the beginning. If you're not from the finance world, you certainly don't know what kinds of options are out there. So the most important thing that you can do is you can talk to your banker, your commercial banker, go down to your bank, see if you qualify for a bank financing, see if you qualify for SBA, and if you don't, say, okay, who can you refer me to? Who are the lenders out there that you would send your rejects to? And I know that's a harsh word, but the bank is such a small bank box that they have to have people that they can refer deals to. So ask them, who would you recommend that I talk to? Talk to your accountant. Who are the lenders out there that would be the right, partner for me? Talk to your advisors. And if you do actually talk to a lender, if you are in front of a lender and you don't fit their lender's box, don't take it personally. Most importantly, find out why you don't fit their box. And then again, ask them to refer you to people within their network where they think they will. And you can say, please refer me to 3 other lenders. I'll make sure they know that you sent me their way. And here's a secret. In the lending world, we're all trading deals. So if you don't fit my box, I want to send you to 3 lenders whose box you may fit. And I want you to say, hey, Jen Palmer told me I should call you because that should in turn give me a deal at one point down the line. So it's a good idea to say, hey, to the lender, hey, to the commercial banker, to the advisor, to your accountant, to your lawyer. I know that I don't fit this box, but I know it's important for you and refer me out. I know this can serve a purpose for you down the line. So please send me in the right direction and I'll make sure that I use your name and something will come back for it for them. It'll show that you know the business, that you know the industry, and that they should take you seriously. So let's say that you do get in front of a lender. Let's get inside the lender's head. So here's some tips. If you do talk to a lender, what are they thinking? How do you best position yourself in front of the lender? That's what we're going to explore now. So get inside your lender's head. The most important thing, and it sounds ridiculous, is to be prepared. And you'd be shocked. It kind of says, it kind of goes without saying that you would be prepared, but you'd be surprised. But first impressions are so critical to any relationship, especially if you're asking this company for money. When it comes to capital, it's really important that you are honest and that you are a professional. You know your business better than anyone else. And a good lender is going to care about your business just as much as you do. And they're going to care about the smallest of details. So don't be surprised when they ask you really nuanced questions. And you should try to have as many of those answers as possible. If you don't, it's okay. You can go and you can say, I've got to come back to you on that, but be prepared. So be prepared to the best of your ability and be prepared to give full disclosure. So talk about the past, present, and the future. When I get in front of a prospect, the first thing I want to know is, where have you been? Where are you now? Where are you going? And why are we talking? That is what I want to hear. And that is what I'm focused on. And it's really comforting for a lender to hear that the prospective borrower has a very solid and realistic handle on their business and where they are within the industry. So talk about your business in reality, not where you think it should be, not where you think it's going. Where has it been? Where is it now? Where is it going in reality? And why are we talking? Have key financial numbers on hand. If you don't know them, make sure that you have your team members on the call so that that first impression shows that you have the team around you who can support you. I'm the perfect example. I'm the CEO. I'm not the CFO. So if I was raising money, I would make sure that my CFO, my controller, they're on the call with me, because the other side may ask such a detailed question that I don't think is important, but it may be important to them. And it's okay if I don't have the answers, but I better have the team that does. So have those key financial numbers on hand, or the people that do. Ideally, you will have all the information in front of you. But if you don't, it's okay to say, you know what? We don't have that key statistic in front of us. We don't have that number in front of us, but we'll come back to you. Don't lie about the numbers or the information that you don't have. Some of the smartest business people that I've encountered are really honest and say, I'll get back to you. So be honest about what you don't understand and what you do understand. Your lender knows that you are not the jack of all trades. You are a powerful salesperson. Your CFO is a really good CFO in this regard, but they didn't think about it from this perspective. This is your first time going out and getting financing. I just never thought about it from that perspective. Let us think about that. Let us caucus and let us come back to you. It's a very respectable answer. The number two thing that you can do when you're in front of your lender is be specific about your needs. What do you need? So many times I get on a call and I don't even know who I'm getting on the call with. My calendar is just jammed. So we jump on a call with a prospective client, and the business owner just jumps into the conversation as though I had been waiting all weekend to have this call. That is not the case. So when you get on a call with a prospective lender, make sure that you remind them who you are, what you do, and what you want. So this is my company. I am ABC company. I sell this, and this is how much money I need. When you start the conversation with that context, the lender can now stop scrolling your website, trying to figure out who they're talking to, going on your LinkedIn page. They can now actually refocus and listen to everything else that you're going to say. But oftentimes entrepreneurs just go into it. Like they're 50 miles down the yard line, and the lender is trying to catch up and figure out what appointment they're on. So again, when you start the call, I'm Jen Palmer. Here's what I do. Here's what I'm looking for. Be very specific. Specifically explain to your lender what your business is, and then specifically explain how much money that you're looking for and why you need it. Spell it out, because the sooner you get the most basic information out, the sooner you're actually having a real conversation. And tie it all again back to your business realistically. Unless you've landed a big order, asking for $5 million line of credit when your sales are $3 million does not win you points. Be very realistic. In the asset-based lending world, what I've found, and the line of credit is usually about 25% of your annual revenue. So if you're doing about $4 million of revenue, $1 million line of credit makes sense. Now, if you're doing $4 million of revenue and you're asking for $6 million lines of credit, I want to know why. I want to know how you're getting there. Do you have a big PO that I'm not aware of? How are we going to get there? The more realistic that you can be with your lender, the more professional that you're going to appear, and the more likely they're going to take a chance on you. And lenders have two businesses. One is to lend money, the other is to get it back. So when you're talking about what you do, how you do it, what you need the money for, make sure that in that conversation, you're going to explain to that potential lender, how are they going to get repaid? Because at the end of the day, we need to get repaid. Make it easy for us to understand, what is our exit strategy. So is it going to be from cash flow? Are you going to refinance us in a couple of years? Are you going to exit? Don't make us think. Lay it all out there for us. The less thinking that we have to do on a call with a potential borrower, the more successful that call is going to be. Be candid. Relationships. This is a relationship. So borrowing money, like I said, is a two-way street. The lender is going to diligence you. You should diligence your lender, your investor, capital provider. But despite everything, understand it's not all about the money. It's about the people behind the company. So again, it's two businesses that we have. One, lending money. Number two, getting repaid. We want to lend to good businesses backed by good people. How do we get repaid? We usually get repaid because there was a great success, or there was a problem, but the company, the people behind the company, they stood up to what we underwrote. So make sure that your potential lender understands who you are as a manager, as an owner, that you're going to be there in the good times and bad. The best relationships are built on trust and an opportunity for mutual success. So be brutally frank and honest about your business and about your principles. At the first meeting, you should be so candid that this lender walks away and says, if there's ever an issue, I know that they're going to come to us, that they're going to be honest and they're going to be proactive, and then maintain that proactivity throughout the relationship. In the beginning conversation, don't spend the whole time talking about your successes and failures, but make sure you touch on 1 to 2 examples of your successes and failures. Lenders love to hear the good, but we know you're salespeople, so we want to hear the failures as well. We want to hear the negativities. Every business has problems. So don't just talk about the good, talk about the bad. And what were those difficulties that you faced? How did you overcome them? What challenges are you still facing on a day-to-day basis? And how are you dealing with them? If you can share your past and current problems with the lender upfront, and you don't scare them, well, that's a really, really important sign for you because you also want to be particular about who you choose. If you share these problems and the lender says, you know what, I'm sorry, I'm scared off, it wasn't the lender for you. So make sure that you own the conversation, make sure that you have confidence in the conversation as well, and maintain the mindset that you're interviewing this potential finance partner as well. They're not just interviewing you, you're interviewing them. So be honest. You deserve a lender who understands your successes, who understands your failures, and who will be there for you in the trenches and help you succeed. And remember that any decent lender is going to independently verify your facts. So don't paint a rosier than reality picture, because then at that point, you're going to lose that potential lender's trust forever. So share the good, share the bad, and be prepared for them to fact check. And you do the same too about your lender. And then you have to prepare a solid package. After you have that first conversation, the lender is going to ask you for a whole host of information. Make sure that you understand what they are looking for. You want to give that prospective lender a detailed package. That helps speed up the process of getting the loan approved, making a great impression. And if the loan isn't approved, well, it allows you to ensure that you move on to the next potential lender even that much faster. It helps keep everything moving very efficiently. Each loan product is very different. So the information that's going to get asked for an ABL lender to a factor to a PO funder, it's going to be very different. So bear that in mind as we go through some of the information that I'll tell you that the lenders are looking for. But the following, list that we're going to talk about, that'll ensure that you're positioning your company in the best light. So again, not too much, not too little. Remember, they're asking you for information to underwrite your business to fit their box. They need to understand that your systems, that your policies, that your financial controls are all in place, that they can check the box from their side, because everybody has to answer to somebody else. We all have shareholders, we all have banks, we all have equity, we all have capital providers that we're reporting up to. So we need to say, yes, this potential borrower, they have systems, they have policies, they've got financials in place. We need to check the box, make it as easy for that potential lender to check the box as possible. So they're going to say, here's what we need in order to underwrite your business for our box. Provide what they have asked for. Do not document dump. I can't tell you how many times I ask for 10 pieces of information and then I'm given 100 and I don't even know where to start. And so you know what I do? I don't start actually. I put it to the bottom of the list. So sometimes giving access to too much information, it's a negative. It may seem like a positive that you want to overshare. You do not want to overshare. You want to make sure if they've given you a list of 10 things that you're providing that list of 10 things and it's coded, that you've given them a key code to it. So if they're asking for number one, your accounts receivable, you're labeling number one, accounts receivable. Look at the information that you're providing from the perspective of if your mother or your sister or your daughter or your brother were looking at it, would they understand what you're providing? Make it idiot proof. So make sure that it's organized. Make sure that it's tied to the list of what they're giving. Put a bow on it, make it as pretty and organized as possible, label the documents as clearly as possible, and do not send documents in piecemeal. If you're sending things two at a time, three at a time, it looks unprofessional and it's going to wear on your lender. There's something called lender fatigue. And the worst thing that can happen is if a lender gets fatigued with a prospect. If they get tired of dealing with a prospect because it's too much of a heavy lift, you're never going to get your loan approved. So again, if they're asking for 10 pieces of information, they've labeled it from 1 to 10, make sure you're providing that information labeled 1 to 10 in a way that they completely understand it. And a lot of times lenders will ask for a budget. This is a very unique time to ask for a budget. Q4, it's always a weird time to ask for a budget. Most companies haven't finalized their budget. It's understandable. Most lenders will understand it's not finalized. But never say to that potential lender that your business doesn't have a budget, that your business is too impossible or too unique to budget. Lenders look at hundreds and hundreds of companies a year. We see all kinds of businesses, again, from zero in revenue to 100 million in revenue. There is no business that is that unique that it cannot budget. A budget is an estimate, and it is really important, even if it is not accurate, that your lender knows that you are forecasting. So at 12/16/24, your budget for 2025 is not finalized, but you have a budget. It's in the works. It's in progress. It will be complete when. Maybe you're going to keep reforecasting throughout the year, but you have a budget because a budget you understand is really important to hold you accountable for the future. And it's really important for you to look back on the past. Financial controls are key. And we want to ensure that our management team of our borrowers is looking back and saying, hey, in October, we only had $200,000 of sales. We thought we were going to have 250. We thought our bottom line was going to be X, but it was Y. How did it happen? Why did it happen? You need a budget to look back and you need a budget to look forward. And lenders, guess what? Also budget. And the only way that we can budget is if you have a budget. So there's no business that is so unique that it cannot budget. So just keep that in mind. Then when you get to the negotiation table, make sure that you are asking for things. Again, it's a two-way street. You're interviewing your potential lender. Have the confidence. You're in the power position as well. You have a lot of options out there. So don't be intimidated by your lender. If you don't ask, you don't get. But don't over push. Understand your lender's box. So you have to understand what they're looking for. And if you're on the smaller side of your lender's box, don't ask for everything. Pick and choose your battles because you're going to get that lender fatigue. Maybe if you're on the higher side of the box, you understand that you can push for a little bit more. So it's really important to know what's important to you and to push forward within the lender's box. And then prepare for diligence. So diligence is a very laborious process. So make sure your lender is going to say to you, make sure you agree on a date that's mutually convenient for both of you. You choose the date. So be ready. If your lender says, are you going to be ready on December 16th? And you say yes, make sure your team is ready. Make sure your CFO is there. Make sure that the information that they've asked for is available. Proactively reach out and make sure that all the information has been communicated, that it's been delivered, that it's been received, and make sure that you're getting feedback. And before the diligence is complete, reach out for an exit feedback. Say, hey, I'd like to have an exit interview. I'd like to understand, how did the diligence go? Because if it's not a go for you, if you're not going to approve me, I want to know why. I want those referrals on to who is the right lender for me. And I want to know what I can do in order to fit your box down the road. And then lastly, when you get to that lender, when you become a client, make sure that, you understand what they're looking for on a go forward basis. Close the loan and demand to have a meeting with them right after and say, what are your expectations of me going forward? I want to know, how often do you want to talk to me? Do you want to talk every week? Do you want to talk every month? Have that proactive communication because you're going to have ups and downs in your business. Lending and running a business, there's pros, there's cons, there's ups and downs. It's a roller coaster. And the time when it's good, when business is good and your lender and you, everything's on track, that's when you build your relationship because there will be a problem. But if you built that relationship when times are good, your lender will react more favorably to you when times are bad. So have that proactive communication. Make sure that you're very transparent. Talk about the good, the bad, the ugly, the misses, the wins, all of it. If there is bad news, if you do have a covenant and you think you're going to blow through that covenant, if you're going to violate it, go to your lender as soon as possible and say, hey, we may have a problem. Here's how I think we can deal with it. I just want you to know what's going on. Maybe we don't have all the answers, but the sooner I tell you this, the better. If you do that, they will absolutely react more favorably than if they find it out on their own or if they feel that you've waited to find it out. So go to them, even if you don't have all the solutions to how you're going to get through it, just go forward. Schedule regular meetings and again, budget early because the more that they understand that you're looking ahead and that you have their best interest in mind, the more they're going to be a partner with you. And then finally, think about this list right here. This is a very comprehensive list of reports. This is an ABL standard document request list. This asks for a lot of information. It's your financials for the last few years. It's your collateral reporting. It's your forward-looking plans. You may not need all this. If you go to a PO funder, you do not need all this. If you go to a factory, you don't need all this. But
Oh.
if you raise venture, if you're looking to raise friends and family money with sophisticated friends and family, if you're looking to raise debt, this is all very relevant information. And even if your lender doesn't want it or doesn't ask for it or doesn't need it, the fact that you have it available shows that you're professional, that you're prepared, and that you're ready to do business with an institutional partner. So always make sure that your files are organized, ready to go. So you look professional. It looks like you understand what the lender wants and that you've got your policies and your procedures in place and that you're following them. And so, Tom, that is a very, very quick high level into the options out there and what lenders want to see.
Well, this is absolutely excellent. If people have questions, please put them in the chat. In the meantime, I have a couple of questions I'd like to ask you. First off, I want to say for those who are looking, whether you're looking for financing or equity, it's a lot of the same things. You're trying to build relationships. You're trying to develop the kind of relationship, that you can move forward, that you can deal with problems, that you understand what the lender or the person that maybe you're trying to interest in equity, an equity placement, what they want, what they need. You're trying to be clear to them. All those great things apply, whether you're searching for lending opportunities or whether you're searching for equity actually input into your company. Hey, Jen, one question I have is on factoring. Okay. One of the things that we try to tell brands is when it comes to dealing with the retailers, dealing with the buyers, is to stay close, build those relationships. Does factoring become a little bit of a wall between that, especially with a lot of brands that start out in independence, where the backroom person who's paying the bills may be sitting next to the buyer or to the merchandiser, those kinds of things. So, how does that play into choosing someone to do factoring in terms of that relationship with the end customer? In this case, a retailer, a buyer, someone that you're actually shipping your product to.
It's a great question, Tom, and I'm glad you brought it up because it's something we talk to young CPG companies about a lot. Factoring absolutely plays a critical place in the financing world, and it helps a lot of companies. I think that the difference that companies need to understand is that factoring is a little less sophisticated than ABL. So even if you have no inventory, you should be thinking about factoring versus ABL. And I believe that ABL is a little bit more sophisticated of a product because we're leaving the relationship to the company. So let's just say that I have a Stanley cup in front of me. So let's use them as an example. If Stanley's my client and Stanley is selling to, again, let's use it Target, and Target doesn't pay Stanley. Well, that's Stanley's problem. And Stanley's going to call Target and they're going to go ahead and make sure that Target pays them. Whereas with factoring, if I was a factor, I would be calling Target and I would be saying, hey, you owe Stanley $100,000, but I factored that receivable. You owe it to me now. Now, that's great for small companies that don't have the back office and need people to help them with their collections. But if you're a sophisticated client, you've got a controller and you've got a CFO, and you really care about the relationships and maintain a good relationship and that view point with your clients, you don't want JPC getting involved with your collection efforts. And I quite frankly don't want to be involved because this is relationships. The information on paper is important. It's all very important. Financials, collateral, great. But at the end of the day, this is a relationship business. And so just as my relationship with my clients is important, my clients' relationship with their customers is important. And I don't want to get in the way of it. So for me, it's very important that my clients are able to deal with their clients directly and I'm not interfering. If I'm interfering with that, it's called an Armageddon. That's what I call an Armageddon event. And Houston, we have a problem, and that is like a doomsday scenario. I've only had 5 days in my 20-year career that we've had Armageddons where you have to get involved. And it's unfortunately because of fraud, it's not because of an issue within the business. So, Tom, to your point, if maintaining that relationship with your clients is important and you don't want your lender interfering, then factoring is not necessarily the right option for you.
That's great. Thank you for that. Because that is one of the things we do tell them, that, that relationship gets you over the hump. If you have a delay in production, if there's maybe a, recall that you have to do and don't get a product there, or you launch a new product, or the warehouse loses the product, all those things
Yeah.
help you when you maintain that relationship.
Yeah, and I think, Tom, just a perfect example is I have a client who's in the Target. I keep using Target. I don't know why. Maybe it's because of holiday season, but I just keep using Target as the example. But this is a real example that we saw the client in October, and we give them 90 days of eligibility on their AR. So basically, they can borrow against their accounts receivable as long as they haven't invoiced that client more than 90 days previously. On the 91st day from that invoice date, it becomes ineligible and they can't borrow against that receivable anymore. And they said to us, they said, we're working with Target on a holiday product. They're not going to pay us for 120 days. And we said, no problem. That's fine. No problem. We'll amend the agreement. You get 120 days for Q4 in 2024. And we'll revisit next year because they were proactive and they were transparent about it. If I was a factor, I probably would have only found out about it on the 91st
91st
day,
day.
and then I would have had to deal with it this way. So it really depends on your company and what you're capable of doing. In that example, they had a CFO, they have a controller, a manager, as well as a CEO. We have regular conversations. I fly out to see them once a month at least, ideally. I shouldn't say realistically, but ideally. And so we sit across the table. And so we're able to have those really honest conversations and get through those situations together in a very professional and sophisticated way.
Excellent, thank you. Another question, we don't have any in the chat yet, but another question I have is, one of the things we like to do at Brandjectory is, make people let people understand what are some of the red flags. Okay, so when it comes to actually starting the financing process, thinking about it, or dealing with the lender. Obviously, I know cash flow is going to come up in there, but what are some of the red flags that you see that are immediate warning signs for someone like yourself in
Mm.
saying, okay, we can't move this any farther down the line? Could you maybe share a few of those?
Wow, that I could talk about this all day. There are so many red flags, but I think the number one red flag is not having access to the team. And so, having direct access to the CFO or the controller is very important. We also are very serious about meeting with clients face to face ideally before we issue a LOI, definitely before we close a loan. And so for me, I have a few different tests. And so I like to if they have a factory, I like to walk the factory. If it's just an office, I like to go through the office. I like to see where the staff are eating lunch or breakfast or what their bathrooms are like. So a lot of times if you go to these site tours and you ask to use the bathroom, they'll give you the executive suite. I don't want the executive suite. I want to see where the employees are going to the bathroom. I want to see where they're breaking, because how you treat your employees is indicative of how you're going to treat your lender. And again, it's a two-way street. I have a business of lending money and getting it back. And so if you're a good person, you're going to treat your employees well. You're going to make sure they have a decent bathroom. They're going to have a decent place to eat breakfast and lunch. And so maybe you're going to help me out if we have a problem down the road. And that's what I'm looking for. So when I can't go to the bathroom or talk to your staff, or I don't have access to the reality in your world, that is a number one red flag. Another red flag is, lifestyle. So we're always, going to see our clients. What kinds of cars are they driving? What kind of lifestyle are they using? Because ultimately, then we're lending the company money. So the money should be used for the company's growth. It shouldn't be used for lifestyle outside of the company. So you want to really understand what is their lifestyle outside of the company too. And then I would say just, another one is not having the access to reports, Tom. I talked about it quite a bit, but being prepared, it's a test. And so if we call over and say, hey, we'd like to get your AR report as of, 11:30, and it takes until January 15th, to get the 11:30 AR report, well, we have a problem. And it's either you don't have systems, you don't have policies, you don't have accurate bookkeeping, or you're hiding something. Those are all red flags.
Okay, excellent. Thank you. Last question that I have, both at a sort of a macro and a micro level for small brands. What do you see next year bringing for them in terms of the opportunity, availability, as the economy changes, hopefully for the better. But what do you see as the opportunities for lending, both for yourself as a company? What are you going to focus on? Is there things you're going to do differently? And then what do you see for those brands that may be under a couple million in sales in terms of the access to financing for them as the year goes along?
Well, my favorite quote ever is attributed to Churchill, and that's never let a good crisis go to waste, right? So, in times of challenge, there's always opportunity. And so, COVID was a very difficult time for companies like JPC. We were competing with PPP money, which was free government money, but we were able to grow our portfolio 140% at our previous firm during that period of time, because we understood what companies really needed during that period of time. And free money was great for some, but not for all. There was a lot of opportunity there. So, I always try to talk to our clients and our potential clients and say, listen, we are in a period of uncertainty, but that is the only certain we have. Right. That is the only constant is change. And so it will continue this period of uncertainty. So we can't use it as an excuse. We just have to move forward and make the best of it. So there is a lot of headwinds going into 2025. Tariffs are obviously at the top of the list. How are tariffs going to impact the industry, impact businesses? And we don't know. We can all speculate, but we truly don't know how tariffs will be rolled out and how it will affect. We also don't understand, how inflation will continue. And Lord knows we don't know what the Fed will do, although we can guess and, we can make speculation. But it's not going to be easy for 2025 for small companies. I do think there'll be some wins. I do think that sponsors are relaxing. I do think they will start writing checks again. So it's been very difficult. 2022 was like a light switch. It just went off. It was on, the sponsorship world was on, and then there was a light switch and it was off. And there was no more private equity, no more venture capital money for a period of time. Last year with the banks, it became even more difficult to raise money. I do think it'll get better. So from that standpoint, it is great because a lot of companies couldn't raise money. So they were actually overusing debt, which was a negative, and that became problematic. And then you had inflation, supply chain issues, all of it. But I think there's great opportunity. And so I think that companies need to continue to focus on profitability or path to profitability because that is what investors and lenders are looking for. They want sustainable businesses. Right now, we are not looking for unicorns. We are looking for sustainable businesses where maybe we're not going to make the huge returns that we heard of in 2021, but we're going to get our money back plus some. So if you have a business and you can focus on making sure that you're curbing the bottom line, you're going to be fine.
And I'm just going to harp in on that because building a sustainable business, profitability as your goal is what we really, really focus on with Brandjectory. We try to tell folks that if you can explain how you're going to make money, money can come to you, and that's you've got to get to that point though where you've forecasted properly, you have processes in place that are going to continue to work as you grow, as you add retailers, as you continue to find customers. Those processes will lead you to profitability, and profitability is what can attract the right kind of financing, be it debt or equity that you need to grow your business. You have to have that in place. So I thank you for getting us to that point in this. This was really terrific. There's a lot of great information here. We will be sharing this recording. We will be sharing the slides to everybody who registered, so expect that. You will find this event on our website also. I put in all the websites, all the LinkedIn profiles, and all the emails for Jennifer, myself, and Susan. So please take a look. If you have any questions, reach out to Tom at brandjectory.com. And I really want to wish everyone on the call. Next week is both Christmas and Hanukkah, so I really want to wish everyone a very happy holiday season and a very blessed and prosperous new year to everyone. Jen, any last comments before we sign off?
I just want to echo happy holidays, everyone. And here's to a bright 2025. And if you have any questions along the way about debt or equity, please feel free to use me as a resource.
Thank you, Jen. I hope you'll join us again for another opportunity with Brandjectory.
Thank you, Tom.
Take care, everyone.
Bye.
Bye-bye.